By more than 2,700 journalists and analysts in more than 120 countries. I'm Vivian Artado.
It was once the country's largest infrastructure financier, had 342 subsidiaries and a very high credit rating, AAA at one stage. But then the cookie crumbled quite fast, with IiAS going bankrupt and the government stepping in to take over control. The defaults left a number of its creditors high and dry, all of whom are now questioning whether the ratings assigned to IiAS debt instruments and firms was appropriate. This is just one of the instances where rating agencies have got their reading wrong, but of course there are a large number where they also get their reading right. How does one look at this debate? The parliamentary panel has used some of these accidents to talk about a change in rules for rating agencies. Joining us to talk about the debate is Amit Tandon, founder and managing director of IiAS. A brief disclosure before we start, Fitch Inc. Is a shareholder in IiAS. Amit, thanks so much for joining us.
Good to be here.
Okay, Amit, this is not an unfamiliar debate. We seem to have it time to time. I have two sort of areas of conversation. One is judging rating agency performance, distinguishing between rating agency performance, and then looking at the rules. Let me start with the first area. Large accidents like IiAS will always grab attention. Rating agencies will come back and say, look, we know that was an important company, had an impact, but look at our performance in its entirety. Which side are you on?
Look, first, let's look at what is the rating itself trying to capture. We kind of, it means different things to different people. At the end of the day, it means safety. But a more nuanced approach is to say that, look, it's rank order, which is that the AAA is better, safer than a AA, which is safer than a single A, and so on and so forth. And the other way of looking at it is that it's, in a sense, reflecting the probability of default. So AAA does not mean that it's not going to default, but the probability of default is extremely minuscule. And as you move down, if it's a AA, it still may default. The probability is higher than that of AAA, but lower than that of single A. So you have to look at it along a continuum and then take a call with regard to what's happened. IiAS is a little bit more complex, and it's complex for a number of reasons. I know that's not the question you asked, but I'm kind of jumping into it. Two reasons. One is, of course, the ownership structure, and you need to remember that ownership does give comfort to the rating agencies, just like it gives comfort to a lot of other investors who are there. So the fact that you've got LIC as a shareholder, you've got HDFC as a shareholder, you've got a couple of sovereign funds, you've got the companies in Japan. Oryx did provide some degree of comfort to the rating agencies. I think what the rating agencies do badly, and as you mentioned in your starting comment that they have about 348 subsidiaries, is that how do you look at the parent-subsidiary relationship? What often happens is that you kind of say that, look, there is support from the parent to the subsidiary, and it is used as a way of pulling up the rating of the subsidiary. But the matching, what should match that is that the rating of the parent should move down a bit. Unfortunately, we don't see that happen here. So in the case of IiAS, it was presumed that a lot of the subsidiaries will get supported by the parent. The parent rating did not move down, but all of the others moved up, which kind of created an impression that everything is okay, and everything is okay for an extended period of time. But we can kind of come on to the specifics of this. Coming to the other question in terms of how do you judge it, I think, of course, the rating agencies have their transition and default matrices. There are regulations under which they're supposed to disclose it. We can talk about it. The other is to see how these the credibility which the ratings have in the market. And it doesn't work so well for bank loans, but certainly for the bond market, you could turn around and say that, look, you've got a couple of these bonds which are rated AAA by different rating agencies. Are they trading at the same price or not? And if there is a price difference, some of that can be accounted for by the how much trust you have in a particular rating agency.
Okay. On that point exactly, and I'll come to the default metrics in a minute. So You have long experience in both the ratings industry and you've seen how the debt markets work as well. Do you see that differentiation come in as to how much investors believe a certain rating or not? Because going by IiAS, for instance, it was pointed out to me that CRISIL, which is the largest agency, has for a long time not rated IiAS for reasons they best know. And some people have said, should that have raised a red flag? Is that distinction made in the market? Who is rating it and at what level?
I think there is a distinction in the market. They do believe that one rating agency is more credible than the other. If you look at some of the larger bond issues, you'll find that there will be two ratings, which kind of just adds to the comfort of the market. So yes, there is some degree of so-called investor preference for one rating over the other, but I'd also then qualify it that some investors have a better grip of one sector rather than the other. So you also need to factor that in, and that's particularly so of much more with the global rating agencies when you say that Fitch understands banks a little bit better. S&P and Moody's have better grip on securitized transactions. Okay. Though over a period of time, I think that distinction is blurring. But for a long time, investors did try and make a distinction between what sector do you have a better understanding of.
Okay. It's not a case that investors also, for instance, tend to, they want to invest in a particular security. They have certain rules of investments, for example, insurance company or mutual fund, certain, criteria based on which they invest. So they will gravitate towards rating agencies which are giving, that rating to those instruments.
Well, we've seen that happen much more on the bank ratings, where, there are two things. And bank ratings, you do have people gaming the system because the lower the rated instrument or the lower the bank loan is rated, the higher is the bank the capital charges which you need to provide for. So therefore, all the banks preferred a slightly higher rating for a particular loan. So yes, that is an anomaly which exists, and in a sense, it also kind of extends to the bond market because bonds haven't been very liquid, and therefore how do you price them?
Exactly.
The way you price them is that CRISIL and ICRA have a pricing mechanism which is used, and most of the mutual funds rely on their pricing tools to give you the NAV at the end of the day. And needless to say, a AAA would give you a better NAV than an instrument which is lower rated. Okay. So it does impact the NAV, and it's kind of based on the spreads. They kind of do say that there's a formula behind it, etc. But it is kind of, it's not unusual for it to be abused time and again.
The other, common abuse that people talk about is obviously companies want higher ratings. But if investors were actually differentiating based on the rating agency which is rated, they would, gravitate away from those agencies which are giving them a higher rating while they don't deserve it. But that hasn't happened.
So there are two ways. Look, investors have the ability to adjust, right? So if I believe that rating agency A is always going to give me a rating which is one notch higher, I'm in the market. I say that, look, if others are giving this AA, I expect this rating agency is going to give me a AA+. I'm going to adjust in the price. And therefore, you actually have to work back and say that, look, is the AAA for all the rating agencies, bonds for AAA for all the bonds priced the same? Now, again, it sounds a little bit simple, but at the end of the day, you could have, let's say, State Bank of India. State Bank is rated by CRISIL and rated by ICRA, and it's rated by India Ratings, and it's rated by CARE, and maybe rated by Brickworks and Infomerics, and the entire. So then if State Bank is trading at a particular price point, it's very difficult to say that, look, are you being able to make a distinction? Because at the end of the day, everybody's rating it, or everyone has a view on State Bank, and it's kind of seen pretty much as being akin to the sovereign.
Okay.
So it is not as straightforward as I'm making it seem.
Okay.
But I do believe that today with technology, today with increased trading in bonds, you should be able to slice and dice data and come up with a number.
But rating shopping is not dead by any means.
Rating shopping is not dead. Rating shopping is not dead. And look, let's face it. I mean, we all blame corporates for rating shopping, but investors love it as much as
that's what I was asking.
Investors love it as much as corporates do. So we should remember that at all times.
And the other thing that has come in is, certain rating agencies, you were talking about a distinction between industries. So, if Fitch was, for instance, considered to be the best on bank ratings. Now, certain instruments are being rated only by, one agency or a couple of agencies, in particular these, equity-backed lending loan instruments.
So, two reasons. One is, in some of these more exotic instruments, I'd say that if one person has done it, everyone will gravitate that, look, you've done it for the others, why don't you do it for me? The other question to ask is that, are the others doing it or not doing it? So it could well be that, one agency is doing it and the others are not doing it. So that is also something which we've seen. So I'm not sure whether very many of the rating agencies were rating some of these single equity structures. It's very difficult to rate them. That's putting it mildly. I think it's impossible to rate them, but nonetheless, if someone's doing it, maybe they've got a mapping, maybe there's a structure put in place. But these are very hard instruments to rate.
Okay. At a macro level, these default rates that you talked about, and we'll have them coming up on the screen as we chat. How much can you read into those default rates? Do they present a real picture? Is that the only thing SEBI looks at, for instance, to judge performance or to pick out, poor performance?
So I think they rely a lot on it. So markets are supposed to rely on it. The question which I have is that, how credible are these? So I think there are two ways in which they're gamed. So one is if you kind of move the rating down from, let's say, a AAA to a, let's say there's a two-notch jump and you move it from a AAA to a single A, and then it moves to default. So it's kind of not moved from a AAA to default, but it's moved from AA to default. Now the way to address it is to look at 1 year, 3 year, and 5 years. So you kind of say what is moved within a period of 3 years from a AAA to a default or a AAA to an A, and you are able to capture it. The second thing is that, look, a lot of agencies say once a rating is withdrawn, we are not tracking it. So if you know that, look, someone is in dire straits and something untoward is going to happen, that there is going to be a blowout which is going to take place in a company, rating agencies kind of actively go out and push that rating away from their portfolio of ratings. So the thing to do then is to say that, look, it's just because the rating has been withdrawn, it does not mean that it does not form a part of your metrics, because one of the things which we had to do at Fitch was, even at the time of withdrawing the rating, you had to say that whether you're affirming the rating or downgrading the rating and withdrawing it. And therefore, you could say I'm withdrawing the rating, and if 2 months later it's kind of down, it defaults, then effectively it needs to be captured in your statistics. So these are the two areas which I think, I'm not sure, I've not kept current whether, people are reporting it this way. The other observation which I have is that, look, if you look at the Indian transition and default statistics, and you look at the global, which is for S&P, Moody's, and Fitch, they kind of resemble each other. Okay. And to my mind, that's not something which really intuitively adds up, because at the end of the day, a AAA in India is equivalent to very roughly a BBB minus globally. So if you, because at the end of the day, that's the sovereign, and most, so you could have a handful of credits which might pierce the sovereign, but for all intents and purposes, a AAA in India would map to a BBB minus globally. And therefore, if you kind of say that, look, the AAA default rates and the AA default rates are 0 or close to 0, and you've kind of got those here, I think you're missing, something is not getting captured in the data. Okay. It cannot be that, if those companies were to, the global agencies were to rate these entities at BBB, and you see the BBB pattern, that India is kind of an island, isolated, cut off from the others, where, our BBB minuses are performing significantly better than how they have in the rest of the globe. So I've not been able to ever map map these numbers.
Okay.
And finally, of course, I don't know what your data shows, but if you've got so many defaults, why is it not showing up in the
Why is there a zero default rate in the AAA category? I was just like,
forget AAA, but even if you look at it, if the default, if you kind of look at the full portfolio, and it's a little bit difficult because they've not kind of disclosed the numbers, but let's say you say that again, expect AAA would be a larger portion, and as you move down, they're smaller. But if you kind of say that, look, I've had a 16% default, and the total portfolio I've rated is X amount, and you kind of do the calculations, it kind of doesn't add up to the stress we are seeing in the banking system.
Exactly.
So why is that happening? Unless you turn around and say, look, all those guys were unrated, or I believe that what's happened is a lot of the people, they've kind of just happily withdrawn their rating and not captured it in the rating data.
That's a good point. There's a disconnect between the banking system stress and what we have in terms of ratings.
And what the transition and default matrices is showing.
Interesting point. Just since you mentioned this global comparison, so Edward Altman was here last week, and he made a point saying that he's surprised that there are so many AAA companies in India when there are just 2 in the US. But then everybody hit back and said, no, that's not the right comparison. But it is, right? I mean,
well, it isn't in the end, because at the end of the day, AAA here is a BBB minus globally.
But the default expectation of a AAA here is the same as the default expectation of a AAA there.
That is what is not adding up. Okay. But look, at the end of the day, I think while we are giving that number, my understanding is that what the domestic rating agencies are doing is a rank order. What the global rating agencies are doing is looking at probability of default.
Okay.
Right? So there is this difference between rank order, which you say that the best credit, State Bank is the best credit, and that's AAA, and, I don't know, Dena Bank is I'm just making it up, is the next, is lower credit, and therefore we're going to give it an A rating. As against the fact
probability
that,
of defaulting.
What is the probability of default? And again, the global credit rating universe has a language of its own. So Moody's so while Fitch and S&P say it's probability of default, Moody's kind of says that we are focused on the recovery level. So if it defaults, what's the recovery? So there are these nuances why each of them is trying to carve out a market share for itself based on their own definitional purposes. But look, at the end of the day, I have 2 observations since you mentioned. One is, there are very few AAAs there, true. But also, if you kind of pick up the top 25 bond issuers, I think maybe 1, at best 2, will have the same rating from the 3 rating agencies.
In India?
No, global. I'm talking about globally 25 largest bond issuers.
Okay.
Maybe 2 have the same rating. Otherwise, there is, it's very difficult to have the ratings of S&P, Moody's, and Fitch aligned with each other. Here again, the other observation is if it is AAA, then a lot of the rating agencies would have it at AAA. Now, that 2 ways of 2 reasons that could be. So one is everyone has that same view, which is what happened for the most with the IiAS. The other is that, look, if someone has a different opinion, it's not accepted. So
that's the scarier part.
That's the scarier part. I don't worry so much at the AAA level, but I do worry at the lower.
BBB or lower.
I do worry at the lower level, yes.
Okay. Let me transition into, the reason this discussion has resurfaced, which is this parliamentary committee which is suggesting another round of regulation changes or, suggesting regulation changes again. Same debate, issuer pays versus investor pays. What is your view? Is there any way that the investor pay model can work?
I think the investor pay model is very difficult to kind of put through. What do you do for retail issues? Let's say I'm selling a bond to one single investor, which is not unusual, they will probably pay for that bond issue, but if they have to sell it, who's going to pay for it? If you kind of just look at the Indian bond market, forget the loan market, I think there'll be about 150, 200 issuers at best. So does it mean that, look, only these companies are going to get rated? Because investors are buying this. They're not kind of coming around and saying that I'm going to buy Shamkin Multifab or what have you. They're kind of saying that, look, I'll buy State Bank of India. So does it mean that, look, only these handful of issues are rated? So I think they're more... there's much more to kind of, it's not as easy. I would say it's almost impossible to kind of put it together. The other is that why do we assume that the investor is wanting to be conservative? the investor could also be pushing for a higher rating, as we've seen with a lot of the bank loans. At the end of the day, it's all very well to turn around and say that the rating agencies goofed up with regard to the ILFS rating, which apart with, it's obvious they have. But the flip side is that, they were issuing paper which was bought by the
savviest of investors.
The savviest of investors. They can't turn around and say we relied only on the rating agencies.
100%.
They would have done their own their own process, checks and balances. They were issuing bonds in the international market, domestic market. You had bankers and private sector, foreign, PSU, all of them willing to give money. So there is something, of course, which shows that it's not that
the model is not responsible for the accident.
Absolutely. It's not that the investors themselves once you say that it's an investor pay model, suddenly you say that, eureka, this will bring an end to all problems. And let's face it, you could begin with a rating and the rating moves down. That also happens. The question is, in this case, maybe they began with the right rating, but the view is it did move down as it should have. And again, I think increasingly rating agencies are a little bit scared, because the moment you start moving a rating down, it becomes self-fulfilling. I remember sometime many years ago, when a lot of the mutual funds, if you know how they invest, they'll say that we'll invest only in AAA and AA rated paper. And IDBI got downgraded. I think it was IDBI before it had become a bank, and it had gotten downgraded. And suddenly the bond market froze, because they couldn't, it had moved down. People were not able, because they couldn't hold a single A paper, they had to sell. Oh, who's going to buy that paper? Because now it's so it collapses on its own weight. So it's not so straightforward. I think, you go back to the financial crisis. We've had this issue with ILFS, and we're talking about it, but we can turn around and say it had the same consequences in India as the 2008 financial crisis. But my sense is that was much, much more widespread and deeper in its impact. But at the end of the day, if you remember, within 3 months, people said, fine, we've had these issues with the rating agencies, but they went back to those very 3 rating agencies. And when you looked at the TARP program, etc., it had to be rated by the rating agencies. And I would, I don't remember clearly, but my sense is that within 2 years, their revenues were back where they were before the financial crisis had occurred. So that's a model which works best. I think one of the things there is the consequences were very severe. So they all recognized that, look, there is a screw up, and therefore there were severe monetary penalties, which some of them, I think, they had to pay on some of these transactions. And I think that is a better way of, I think you have enough regulations. I don't think you can second guess what the rating agencies are. You're not, either you sit in the room, let SEBI send someone and they decide what's happening.
There is a suggestion for a regulator pays model. Maybe they can go to a regulator rates model.
Maybe they can have a regulator rates model. But at the end of the day, what you have to do is say that, look, the consequences of this have to be high, but you have to, as your opening remark was, that they by and large get it right. We always remember the failures.
But
the good the men do is forgotten, but the evil lives after them.
It's certainly true for rating agencies. Okay, so a couple of more questions. So investor pays seems to be, the preference. Most people say that that's the way to go.
I don't
no, sorry. Issuer pays. Sorry, my fault.
With the issuer
pays. I mean, from your experience, are there enough checks and balances to avoid conflict of interest? Because a lot of the rating agencies get into consultancy. That's the other thing that I thought that was a valid point. That do we need to look at those firewalls once again?
Look, my own experience is that there are sufficient checks and balances, but at the end of the day, if you look at the revenues here, most of them are a single product. I mean, I don't know that, CARE, for instance, has a small IT subsidiary which is trying to get a little bit of business. When you've got CRISIL has a large business, a lot of it is outsourcing rather than anything else. So it's not of the same order of magnitude as you see with the accounting firms.
Okay.
In fact, just compared to it, it's not there at all. I think they're worried about it in as much as the companies paying them. That is what they're worried about. But again, I suspect if you look at any of the large ones, no one person will account for more than, or should account. Maybe that's the other way to look at it, is that does anyone account for more than 1%, 0.5%, 0.25% of the revenue, and base it on that rather than turn around.
And if so, then don't rate the company.
If so, then that needs to be addressed. That's a different way of addressing it in terms of conflict of interest. But you have that, which is, as I said, seems to have worked all these years.
Okay. The last point of conversation is that they have suggested this mandatory rotation of rating agencies.
I'm not sure what will accomplish. I've kind of got a rating. I should be held responsible for it from start to finish. Then I've kind of, my transition and default matrices and all the other tools through which I'm measuring my performance cease to matter. I've kind of rated them for 3 years, and maybe I've kind of said that, look, I want, I'm giving a higher rating, and therefore most people are coming to me. And, the probability of default over the next 12 to 18 months is relatively short. I give a high rating, pass it on to someone else and say, now it's your problem. I don't think it's going to work. You have to have people who are there right from the beginning to the end.
And it will lead to unpredictability of ratings, right? Suddenly it goes from one to the other says it's single A instead of, double A plus.
Instead of double A, and then you've got a problem. So I don't think that works.
Is there any parallel between what happened on the accounting side, auditors?
On the auditor side?
Yeah.
No, there's no. Again, there's 10 years there, which is sufficient period. So I don't think the same thing applies, because at the end of the day, what you're rating is, you're kind of rating it for, but at least the way the market works here is you've rated a particular instrument rather than not so much the company. And therefore, the investors would want some degree of certainty. The other is, of course, that when the newer companies come in, the only way they get, you've got an existing set of players who've got credibility. The only way the new, and look, at the end of the day, the way of analyzing a balance sheet has not changed in the last 30, 40 years. What mattered then matters now. You could have a view that, look, there are nuances. So let's say CRISIL would give a slightly higher weightage to the balance sheet ratios. Fitch might give a slightly higher weightage to the cash flows, but that is 45, 55 kind of thing. So it doesn't kind of materially change things. Or I might have a more positive outlook on one sector rather than another, which means that, look, I might tend to be either a notch higher, or my outlook might be positive. So on the expectation that I'm going to change things a little bit faster. But that's the kind of thing which you're seeing. It's not so dramatic as to say that, look, you need to change things.
And also, if you do this mandatory rotation, then if you want differentiation based on performance of rating agencies, then you reduce that even further.
Absolutely. Absolutely. I think people have to, I think the regulators need to take a hard look at the data, maybe, say that the data would be looked at by them. They collect the raw data and add some of these checks and balances and then do it. RBI can quite easily say that the risk weightage for a AAA by one rating agency is going to be different than
That's
for a
tough for the RBI to do, isn't it?
Well, it's not tough. They're getting the data. They're looking at what the statistics is. So they have that data. So they could actually change the risk weightage for different rating agencies.
That's interesting.
And that is actually signaling to the market that, look, and it comes back to the point I made earlier that, look, my AA plus is equal to your AA. And that's what the market is saying. If the market can signal it through the bond rates, surely RBI can signal it through the risk weightage. So maybe they need to take a hard look at, revisit this. The other is, so it kind of tells the rating agency that, look, you're behind the curve. And the other is to, as I said, maybe look at, revisit the monetary fines. They should be a lot more. You could at least turn around and say, look, whatever you've received as fee, 3 times the amount you've received as fees needs to go into the investor protection fund. For bond investors.
For bond investors, particularly, they'd like to hear that.
That's right.
And at the last step, as in, if things are really extreme, you can withdraw a license. Right?
You can withdraw. You have, it's, I think, given for 3 years or 5 years. I'm not sure, but 3 to 5 years, you could actually always withdraw the license.
So your final verdict is stricter supervision, not constant adjustment in regulation.
Absolutely. I would say that, just a tweak in terms of how they are being monitored. I don't think you need to change it to 3 years. Regulator pays, rotation, investor pays. All that seems to have worked pretty well and seems to work around the globe. There's no reason why, if people are a little bit more conscientious in terms of what they're doing, that means the regulators, the rating agencies, but also more importantly, the investors, we are home and dry.
All right. Amit Tandon, I'll leave it at that. Thank you so much for this conversation.
Thanks a lot. Bye. Done.